Trading is more than just charts and numbers. It's a mental game. Understanding your own mind is as important as understanding the market. Your emotions can be your biggest asset or your worst enemy. Many traders focus solely on technical analysis and market indicators. While these are important, they neglect the psychological aspect of trading. Mastering your emotions is key to making rational decisions in the face of volatility. Think of it like this: you can have the best trading strategy in the world, but if you let fear dictate your exits or greed cloud your judgment, you won't succeed. Your mind can sabotage even the most promising trades. To win in the market, you must first win within yourself. This means understanding your emotions and how they impact your trading decisions. It's about developing discipline, patience, and a realistic outlook.
Fear is a natural human emotion, especially when it comes to money. It's an instinctive response that has helped humans survive for millennia. In trading, fear can manifest in many ways. It can creep in quietly, influencing your decisions without you even realizing it. It might make you hesitate to enter a trade, even when your analysis is positive. You second-guess yourself, wondering if you missed something, or it could cause you to exit a trade too early, leaving potential profits on the table. The fear of losing what you have can be overwhelming. Imagine this: you've been following a stock that's been steadily climbing. You've done your homework, and everything points to a good opportunity. You finally gather the courage to buy in. The moment feels right, and you feel a sense of accomplishment. But as soon as you do, the stock dips slightly. Fear sets in, and you start to doubt your decision. You panic and sell, only to watch the stock continue its upward climb without you. The regret is immediate and stinging. This is a classic example of fear driving a trading decision. It's a painful lesson many traders learn the hard way. The small dip was just normal market fluctuation, but fear made it seem like a disaster. It's easy to misinterpret these movements when emotions are high. Learning to control fear is crucial. It requires practice, patience, and sometimes a bit of soul-searching. It's about trusting your analysis and not letting short-term fluctuations shake your conviction. Confidence in your strategy is key. Remember, every trader experiences fear. It's a universal emotion that doesn't discriminate. The key is to not let it paralyze you. Acknowledge the fear, but don't let it dictate your actions. Develop strategies to manage fear, such as setting stop-loss orders and sticking to your trading plan. These tools can help you stay grounded and focused.
Greed is the flip side of fear, and it can be just as destructive. It often starts with the thrill of a big win, the excitement of seeing your investments grow rapidly. It's the desire for quick riches, often leading to excessive risk-taking and ultimately losses. The lure of easy money can cloud your judgment, making you take risks you wouldn't normally consider. Greed can make you hold on to a winning trade for too long, hoping for even bigger profits. You might ignore the signs that it's time to sell, convinced that the stock will keep rising. This can be disastrous when the market reverses and wipes out your gains. The sudden downturn can leave you with significant losses, erasing all your hard-earned profits. It can also lead you to overtrade, taking on more risk than you can handle. Overtrading can deplete your resources quickly, leaving you vulnerable to market fluctuations. Think of a gambler who keeps betting, even as his winnings pile up. He believes his luck will never run out, and he keeps pushing his luck further. He's convinced he's on a hot streak, but eventually, his luck runs out. The same winnings that once seemed endless disappear in an instant. The same principle applies to trading. The market can be just as unforgiving as a casino. Greed can blind you to the reality of the market. You might ignore warning signs and red flags, convinced that your strategy is foolproof. It's essential to set realistic profit targets and stick to them. Having a clear plan can help you avoid the pitfalls of greed. Don't let the allure of just a little more lead to significant losses. It's better to secure your gains than to risk losing everything for a bit more. Remember, trading is a marathon, not a sprint. Patience and discipline are key to long-term success. Consistent, disciplined profits are better than chasing unrealistic gains fueled by greed. Focus on steady growth and you'll build a more secure financial future.
Overconfidence often follows a string of wins. You start believing you've cracked the market code, that you can predict every move. This inflated ego can lead to reckless trading and, inevitably, painful losses. An overconfident trader might start ignoring their trading plan, taking unnecessary risks and oversizing their positions. They believe they're invincible, but the market has a way of humbling even the most seasoned traders. Imagine a poker player on a winning streak. He starts playing looser, making riskier bets, confident that he can't lose. But eventually, his luck changes, and he loses everything he's gained, and more. Overconfidence can be a slippery slope. It's crucial to stay grounded, acknowledge that losses are part of the game, and never stop learning. No matter how many winning trades you make, remember that the market is always in control. Stay humble, stick to your plan, and never underestimate the market's ability to surprise you.
Jesse Livermore, A Case of Emotions and Trading. Jesse Livermore, a legendary trader of the early 20th century, is a prime example of how emotions can make or break a trader. Livermore made and lost fortunes. His life a roller coaster of incredible highs and devastating lows. Livermore was brilliant at reading the market, but his emotions often got the best of him. He was known for his bold bets and his tendency to hold on to losing positions for too long, driven by a combination of overconfidence and stubbornness. Despite his immense talent, Livermore's inability to control his emotions ultimately led to his downfall. He tragically committed suicide after suffering devastating losses. Livermore's story is a cautionary tale. It highlights the importance of emotional intelligence in trading. Even the most skilled traders can be undone by their emotions. His story underscores the need for robust risk management, discipline, and a deep understanding of one's own psychology.
Section 6. Recognizing your emotional triggers. The first step to mastering your emotions is to identify what triggers them. What events or market movements cause you to feel fear, greed, or overconfidence? Keep a trading journal. Record your trades, but also note your emotional state before, during, and after each trade. This will help you identify patterns in your behavior. Are you more likely to make impulsive decisions after a big win or a string of losses? Do certain market conditions, like high volatility, make you anxious? Once you understand your triggers, you can develop strategies to manage them. This might involve taking a break from trading, practicing relaxation techniques, or adjusting your trading plan. Remember, self-awareness is key. The more you understand your emotional responses, the better equipped you'll be to control them.
Section 7. Building a trading plan to combat emotions. A well-defined trading plan is your best defense against emotional trading. It serves as a structured approach to navigating the complexities of the market. It acts as a roadmap, guiding your decisions and helping you stay disciplined when emotions run high. By having a clear plan, you can avoid the pitfalls of emotional reactions. Your trading plan should outline your entry and exit points, risk management strategy, and profit targets. These elements are crucial for maintaining consistency and achieving long-term success. It should be based on your analysis and back-tested to ensure its viability. Backtesting allows you to see how your strategy would have performed in the past, giving you confidence in its potential. When you have a plan, you're less likely to make impulsive decisions based on fear or greed. This calmness can be your greatest asset in volatile market conditions. You'll know when to enter and exit trades, and you'll be prepared for different market scenarios. Preparation is key to handling unexpected market movements. Think of your trading plan as a set of rules designed to keep your emotions in check. These rules act as guardrails, ensuring you stay on track. It's a pre-commitment to a strategy, preventing you from making rash decisions in the heat of the moment. This pre-commitment can save you from costly mistakes. A solid trading plan is not static. It should evolve as you gain experience and learn more about yourself as a trader. Regularly updating your plan ensures it remains relevant and effective.
Section 8. The power of patience in trading. Patience is a virtue, especially in trading. It's about waiting for the right opportunities, avoiding impulsive decisions, and trusting your analysis. Impatient traders often jump into trades prematurely, chasing quick profits or FOMO, fear of missing out. They exit positions too early, fearing potential losses, or hold on for too long, driven by greed. Patience allows you to wait for your setup to form, to enter trades at the right time, and to let your profits run. It's about staying disciplined and not letting the market dictate your actions. Imagine a sniper waiting for the perfect shot. They don't just start firing randomly. They wait patiently, observing, calculating, and only taking action when the time is right. Trading requires a similar mindset. It's about being selective, waiting for high probability setups, and avoiding the temptation to chase every market move.
Section 9. Embracing losses, celebrating wins. Losses are an inevitable part of trading. Accepting this fact is crucial for maintaining a healthy trading mindset. Don't let losses discourage you or make you question your abilities. View losses as learning opportunities. Analyze what went wrong, adjust your strategy if necessary, and move on. Dwelling on past losses will only cloud your judgment and lead to more mistakes. Similarly, don't let wins go to your head. Celebrate your successes, but don't let them fuel overconfidence or recklessness. Remember that every trade is a new opportunity, and past performance is not indicative of future results. Maintain a balanced perspective. Trading is a marathon, not a sprint. There will be ups and downs along the way. Focus on the process, stay disciplined, and the results will follow.